When we look at a corporation's balance sheet, we tend to see it as a hard, objective reality. It is a pure mathematical reflection of financial health. But crack the surface, and you'll find it's highly malleable. Management uses the inherent flexibility of accounting rules to curate this ledger, shaping how investors and lending institutions perceive the company's underlying risk. This equation shows the debt-to-equity ratio, a key metric tying directly to a company's market valuation, credit rating, and even executive compensation. If management can simply remove debt from the top of that equation, they instantly present a smaller risk profile to the market. This is achieved through off-balance sheet, or OBS, financing. It's a complex array of accounting mechanisms that allow a company to secure funding or control massive assets without the legal obligations ever appearing on their primary financial statements. By navigating the technical boundaries of accounting rules, OBS financing creates an invisible vacuum. Companies can project an image of perfect financial discipline while hiding billions of dollars in debt in plain sight. The catastrophic potential of this practice is best illustrated by the Houston energy giant Enron. In the early 2000s, Enron took off-balance sheet mechanisms to their absolute fraudulent extreme. Their strategy relied on a specific accounting loophole of the era known as the 3% rule. Under the standards of the time, a company didn't have to report a special purpose entity, a separate corporate shell, on its main ledger as long as an independent third party held at least a 3% equity stake. Enron exploited this by installing its own employees as those supposedly independent investors. These internal executives ran the off-the-books entities, while Enron secretly guaranteed the debt themselves through side letters and unsecured bank loans. This diagram maps out the Raptor's circular collateral loop. Enron used these entities to ensure its high-risk tech investments, but funded them using Enron's own stock. When the tech bubble burst, both crashed simultaneously, leaving the Raptors unable to pay their insurance obligations. When auditors finally uncovered these sham structures, Enron was forced to consolidate the hidden entities onto its main ledger. The result was a sudden, massive surge in reported debt that instantly bankrupted the company. When OBS financing is deployed to manufacture earnings rather than legitimately isolate risk, it introduces a systemic fragility capable of dismantling global giants overnight. Enron is a cautionary tale of fraud, but you don't have to break the law to hide debt. For decades, the global aviation industry operated on a completely legal pay-as-you-fly leasing model to keep their immense capital obligations off the books. Under legacy accounting standards, a lease only appeared on the balance sheet if it met specific criteria that classified it as a purchase, like if the lease term exceeded 75% of the aircraft's useful life. Airlines became masters of strategic violation. They would carefully engineer 12-year contracts that ended right before hitting that 75% threshold. By keeping the duration just short, these disguised multi-million-dollar purchases were legally classified as mere operating rentals. The scale of this practice was massive. Major carriers like U.S. Airways could operate enormous commercial fleets, owing billions of dollars in future rent, and yet report virtually zero aircraft debt on their balance sheets. The obligations were buried deep in the footnotes. This legal loophole created a severe transparency gap. Investors looking at the top-line numbers found it impossible to accurately compare the financial risk of an airline that borrowed money to buy its planes against one that leased them. By 2005, standard setters realized the sheer size of the problem. The U.S. Securities and Exchange Commission estimated that public companies were hiding over $1.25 trillion in lease obligations globally. To close the operating lease loophole, regulators rolled out new standards known as ASC 842 and IFRS 16. These rules introduced a concept called the right-of-use asset, effectively ending the era of the off-the-books rental. This formula calculates the present value of an annuity. Regulators forced companies to use it to tally up every single future lease payment, apply a discount rate, and record the entire sum as a hard liability. Overnight, standard setters finally pulled back the curtain. They successfully shifted an estimated $3 trillion in commitments out of the obscure footnotes and directly onto the main financial statements of global multinationals. The end of the lease loophole didn't stop the pursuit of incognito leverage. The battlefield simply shifted to new, increasingly complex legal architectures. Today, companies use tactics like factoring. They sell their unpaid customer invoices to financial intermediaries for immediate cash. By structuring it as a true sale rather than a secured loan, they boost their working capital without adding a single dollar of reported debt. They also use the equity method for joint ventures. By maintaining a specific minority ownership stake, a parent company can partner on large infrastructure projects and hide immense leverage behind a single consolidated line item labeled investment in joint venture. These creative interpretations are often driven by the immense pressure to avoid missing an analyst forecast or triggering a loan default. When executives believe a financial dip is only temporary, they frequently use the flexibility of the rules to bridge the gap, a behavior fueled by overconfidence and an intense desire to avoid the immediate fallout of a reported loss. Financial transparency is a perpetual race between standard setters and corporate engineers. To understand a company's true financial health, you have to look past the curated numbers, read the technical assumptions, and actively hunt for the invisible